So when it comes to residency, the common question comes up: how you define a residency? Like I said, is based upon the 3 months rule, 3 month and extended period. Now the thing we have to look into is, let's say you are here for, let's say, 2 months, and then you go to other state, and you start working in another state, but your family is living here. Your kid is going to school here. You have a DMV license from here. Your voting registration is here. So in that case, also you will be subject to California taxes because you have a nexus, a family connection, a nexus, family nexus here. So we have to be very careful when you look at residency requirement from the point of view of the state of California. So, like I said, if you are a California resident, you are going to pay tax on the salary, on the rental income, on business income. Not only that, if you have invested in other businesses outside California, so California do tax you on the worldwide income, not only the source, the California taxes income, but also the outside income, including foreign income, including income from, let's say, your property in India, rental income or the sale of property. California will, you have to pay California taxes, and a lot of people get surprised and shocked when they find out they owe California taxes on the sale of foreign property, like in India. And California does not allow any foreign tax credit because that's a provision. They don't allow foreign tax credit. So you pay double taxes. You owe Indian taxes, you owe the federal tax, there might be differential, and also you owe the California taxes. So that's part also you one need to take into consideration. One important area for California tax is a differentiation between federal tax and California taxes. Lot of things which federal tax provides, California tax take it out. Important thing is, for example, is I would say long-term capital gains. There is no long-term capital gains tax rate in California. There is only one rate, which is normal rate. So California's tax rate starts from around 3 to 4% and goes up to 13.3% if you make more than $1 million. So there is no special rate. So in case of federal, there is a special rate. Long-term capital gains are taxed at 15%. It can go to 20% plus 3.8% Medicare tax. California tax it as an ordinary income. So beware of that rule of there is no special rate for California. One more difference is there are a lot of other things which California does not conform to federal from giving deductions. So one has to understand those areas as well. So California tax form is 540 and also have 540 NR for corporations. It says 540, 565, 568. So all those forms are there for tax purposes, but you have to understand differentiation between the federal rule and California rules. For example, for business owners, California taxes, the depreciation rules are different. For equipments, for example, they give you 179 up to $25,000 for 170, and for federal it can go up to $2 million deductions, as everyone knows. And there's a QBI deduction which business owners take for their businesses, which California does not conform to the QBI deductions. So California tax is definitely a surprise package for everyone. Everyone always says, "Oh, why I'm paying so much California taxes?" Because California you have to pay. We don't take into consideration the California tax account. Now, the other thing one has to understand is franchise tax board, which is a state tax agency. Now, franchise tax board treats itself far better. They say we are the bigger than IRS. So when it comes to franchise tax board, make sure you do the proper estimate tax payment to them. Make sure you do the LLC fees if you have an LLC upfront. And when you receive notices from franchise tax board, delete it immediately. And I will suggest, because franchise tax board they send notices only after 1 or 2 years with all the penalty interest, and they send you all kinds of interpretation regulations. You will not. I will, from my experience, I will say you will owe lot of penalty interest, and you will not be you will not be able to walk out from there, or saying some kind of excuse or something. So do be careful on that account. And there's a Secretary of State filing too for business owners. Make sure you do that filing. A statement information is there, and also there's a Secretary of State filing fee also. So those are the California state income state tax regulations. Another question that comes up: is there any way how I can avoid California taxes? Yes, definitely there are ways to avoid California taxes, but that will be based upon the domicile, the residency requirement. You can always, when you decide you have a lot of income to come in, you can plan your timing of going out of California, staying in another state, let's say Nevada or Washington State or Texas, for at least 2 years. There's a 545 days rule. So if you stay outside California for more than 545 days, then you're not subject to California tax regulations. So there's one way, or you can start investing your money outside California, like buying property outside California, uh, transferring stocks, gifting stocks to people, your kids who are residing outside California. Those are like some creative ways where you can avoid paying the California tax. In most cases, we have seen it's not possible. People are given up to California residency just because of that. That's what. So be careful on California taxes, residency requirement. Any questions, you can connect with us and let us know.